All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. If you've been searching the internet looking for information on investing in real estate using a life insurance policy, you've come to the right place. So be sure to bookmark this channel and come back often to check for new videos. Today, we're going to be talking about how much money can I borrow from my life insurance policy. And I realize that that's technically wrong, but the search engines, that's what you guys are searching on. So the video is titled, How Much Can I Borrow From? But clearly, when you're taking a policy loan, it's important to understand that you're borrowing against the policy's cash value. But that's the topic for today's conversation. If you're interested in learning how much you can take as a loan from your policy, stick around after the intro and I'll break it all down for you. All right, thanks for sticking around. I'm Tom Rutkowski with Innovative Retirement Strategies. I'm a life insurance agent specializing in designing maximum overfunded life insurance policies that can be used for investing in real estate. The goal of this channel is to provide all the information that you could possibly need, answer all the questions you could possibly have about life insurance and real estate investing so that you don't have to talk to a life insurance agent. The only time you should have to talk to me is when you're ready to see what the numbers look like for yourself. So again, today we're talking about how much money can I borrow against my life insurance policy. Now, if I'm putting in $20,000 of premium, how much can I take as a loan immediately? Because you've watched the videos in the past that I've done and you know that you can access a policy loan right away after the policy is issued. So let me just get started. Starting with my usual disclaimers. There is no financial advice in this presentation. This is all purely educational. There's no financial advice, no tax advice, no legal advice. And I just want you to understand that the primary purpose of life insurance is for the death benefit protection. Any other benefit is purely ancillary. So, all right, let's kick this off. In this video, I just want to show you how big of a policy loan you can get right away when your policy is issued based on the amount of premium that you're putting in. And for the most part, we're going to express the loan size in terms of percentages of the initial premium. Some of the basic fundamentals that you need to know before you watch this video. It would be helpful if you had watched or read the blogs that I've got on how life insurance works, understanding policy expenses, and the difference between minimum and maximum overfunded life insurance. So some of the things we're going to be talking about in this video are the power of maximum overfunded life insurance policies, some of the key features that you need for optimal borrowing. We're going to look at an illustration and I'm going to show you just how to figure out exactly how much you can borrow. And just some basic need to knows regarding policy loans, some cautions and considerations, and then we'll wrap things up. All right, so let's kick it off with the power of maximum overfunded life insurance policies. So a maximum overfunded life insurance policy allows for the highest cash value relative to the premium that you're paying. So the policy is solved for the lowest possible death benefit, highest possible cash value, and that's right up to the legal limit. You can't put one more dollar into one policy like this without violating the definition of life insurance. And since it's got the most cash value, it also offers the highest leverage relative to the premium that you're paying. And typically, if the policy is designed right, you can access about 80 to 85% of the premium amount that you put in as a policy loan right after the policy is issued. But again, the policy has to be designed right. Overfunded policies, I just want to be clear, are not maximum overfunded. So these are what you typically would see from the infinite banking folks, the bank on yourself folks, the be your own bank folks, and anybody else typically dealing with whole life and private banking. They set these policies up with more death benefit than was really needed. And that gives the ability to add more premium later. And as I said, a maximum overfunded life insurance policy, you cannot add one more dollar to it without violating the definition of life insurance. But in the infinite banking model, they kind of fool you into thinking that you're paying yourself interest on loans that you take. But really, that interest is just what's called paid up additions. It's additional premium that's going into the policy at a later point in time. And if you're a real estate investor and you want to put your money to work, if you're putting, just to keep round numbers, if you're putting $100,000 into a policy and you're only getting $65,000 of cash value, that's not really what you're looking for in terms of putting your money to work in two places at one time. Even 85% of $100,000, $85,000 is not perfect, but the numbers work and you will create more wealth over time. So just be wary of overfunded policies. When you're looking at a policy illustration and you want to use the policy for real estate investing, that policy really needs to have 85 to 90%. What you're looking at when you're looking at the illustration and you see the first year cash value numbers, those numbers need to be about 85 to 90% of the premium amount. That means that the policy is pretty darn close to being maximum overfunded, if not perfectly maximum overfunded. And lastly, traditional funded life insurance policies are just policies that 99% of the people buy. When they're looking for a policy with a $1 million death benefit, they typically want to get that death benefit for the lowest price they possibly can get it. So these policies, they collect just enough in premium so that the cash value grows and the policy owner essentially ends up saving up their own death benefit over the course of the lifetime of the insured party. So these policies, great for death benefit, horrible for the double play, investing in real estate using life insurance. So let's just take a minute and talk about whole life and indexed universal life. So far, I've just talked about maximum overfunded policies. And the point I really want to get across here is that it doesn't matter. Both whole life and indexed universal life can both be designed for maximum overfunding. It's the agent who designs the policy, whether it has high death benefit, low cash value, or high cash value and low death benefit, or somewhere in between. But you want a policy, if you're investing in real estate using life insurance, you want a policy that's got the most cash value and the lowest possible death benefit. That low death benefit is going to keep the fees and expenses down to an absolute minimum. And one additional note that I should add is that in the case of an indexed universal life, you typically need to put what's known as an early cash value rider, or a rider that waives the surrender charges on the policy so that you've got full access to the cash value. And it's just important to realize that not every company offers that kind of rider. So it's important, again, to work with an agent who specializes in these types of policies to make sure that they understand what you're asking for and what you're going to be getting from them. Whole life policies, on the other hand, are most of the cash value is in the form of paid up additions, and those are liquid from day one. So you don't need to have that rider with a whole life. Almost any whole life company will work for this. The only thing you need to be aware of there is just, look at the ratings of the company and the dividend that they're paying, and understand the mechanics of the dividend. And if you don't understand that, I've got videos that I'll put a link to so that you can go back and look at that. Because not everybody calculates dividends based on the same mathematical formulas. All right, let's talk about key features for optimal borrowing now. So first and foremost is the policy has to have the maximum cash value. That goes without saying. 2 is it needs to have no surrender charges. And really, again, as I mentioned, this only applies to index universal life. But the third is that you really need to have favorable loan terms. I've seen whole life policies where dividend rate is 5.5%, and they're charging 8% for loans. That is not a policy that is going to be useful for the double play. You're starting off with a negative arbitrage, and that's not something that you want to be doing. So look for policies that have variable loans that you can access immediately. And again, not every company has this. So again, you have to be careful who you're working with and the policies, and make sure that variable loan is available immediately after policy issue. Because sometimes they make you wait up to 5 years before you can take a variable loan. So that needs to be available on the policy right away. And lastly, in the case of the double play, you want to be concerned about direct recognition loans versus non-direct recognition loans. And what that means is a direct recognition loan, the insurance company does not typically pay dividends on the cash value that is actually securing the loan. So that's not a double play, right? You would be taking the money as a loan from against your policy, and you'd be putting it to work in your real estate investment business, and you'd be paying interest on that loan. But the corresponding cash value inside the policy is treated as if it was withdrawn. So it's not earning anything. So that's not a double play. That's a single play. A non-direct recognition loan, on the other hand, is a loan where they disregard the loan itself, and all of the cash value earns dividends or interest crediting as if all the money was still in the policy. And I mean, the money never leaves the policy. Again, you're borrowing against it. So the insurance company is loaning you their money, but that cash value in the policy is serving as collateral for the loan. So that's the important thing. So again, main point here is, for the double play, you need to have a policy with a non-direct recognition loan. And if you go out searching for information on this online, you're going to see all kinds of whole life guys that work for companies that offer direct recognition loans, talking about how it doesn't matter and how over time the cash value grows better, yada yada. The point is, if you take a direct recognition loan, it's a single play. And I hope that's more than enough explanation for you. All right, so let's take a look at an example illustration right now. And there's a number of things that I want to point out to you on here. So first thing, this is a policy on a 60-year-old, and I threw that in there. Actually, this is a real illustration that I provided to a real client, and I just left off the name and any personally identifiable information. And this is a 5-pay of $100,000 each year for 5 years. And so I'm going to do two things. I'm going to show you the loan calculations, how much you can borrow. And then I'm also going to show you some of the key features of a maximum overfunded life insurance policy. So you can see the third column from the right that there are 5 years of $100,000 a year going into the policy. And again, I shouldn't say again, I just want to stress that the $100,000 number, when people understand how well this works and understand the mechanics behind it, they typically want to put as much into it as they can reasonably afford. And I kind of wanted to use the $100,000 example for this because it's a nice round number. And you can see with the $85,000 of cash value in the next column over, you can see that that's basically 85.7% of the 100,000. So the numbers work out nice. But for yourself, just, you don't have to fund a life insurance policy with 100,000. You can cut it in half. You can double it. You can divide it by 10 if you wanted to, and only do $10,000 a year. But everything is relatively scalable. Obviously, the more premium you're putting in, the more the costs are being spread out across a little bit more dollars and higher pooling amounts. So the fixed costs, eat up a little bit more at the lower end, around $10,000 a premium, but it's still relatively close to this. So one thing I want to show you here is, just again, even for a 60-year-old, there's still $85,000, almost $86,000 of cash value at the end of the first year. And, based on this illustration, we're showing there's no interest crediting occurring in the first year. So the cash value is actually equal to the premium less the expenses. So if you move over to the column at the right, labeled total expense, these are the total policy charges, which are typically higher during the first 10 years. I should just point that out, and then they drop off. But take the $100,000 premium minus the $14,000 of expenses, and you're left with $85,724 of cash value that you cannot tap into, or that you can tap into. You just can't go any higher than that. And then the key thing I want to talk about here is it's important to realize that these expenses, the $14,276, those aren't taken out all up front. They're taken out in monthly increments all throughout the year. And over the course of the year, it's going to sum up to the $14,000. So if you go into your account on day one, you're going to see that the cash value is actually quite a bit higher than what your illustration is showing. And if you call up and ask them for a maximum loan, they're going to give you something well in excess of $85,000. And here's the problem. When the insurance company comes back to take out the charges the next month, and you don't have enough free unsecured collateral or cash value in your policy, that policy is going to lapse. You're going to get some warning letters to top it off, put some more premium into it, but really you can't put any more premium into it because it's a maximum overfunded policy. So you're going to have to reduce that loan if you were to do that. And this actually comes up quite often. I cover it a lot in my calls with clients, but still, when people get excited when they see that amount. So, or they simply presume that the insurance company is accounting for it, for the fees and expenses, and that's not the case. So again, that's a caveat that you need to be aware of, and I'm going to address it one more time later in the presentation. The next thing I want to show you is just, what to look for in a maximum overfunded policy. So if we understand that the premiums are only being paid for the first 5 years, we need to keep a certain amount of death benefit protection going for that time while you're putting $100,000 in. But once you're no longer putting $100,000 in every year, now we can slash the death benefit to reduce and drive down the cost of insurance inside the policy. So if you look at where I've got it highlighted on the screen right now, the death benefit in year 6 was up to $1.5 million. But in year 7, it's being reduced to $630,000. And that's on top of only $530,000 of cash value. So we took almost $1 million of death benefit, $900,000 or so, and basically reduced it to just $100,000. So the cost of insurance has been dramatically reduced in the policy. So the next thing that I want you to understand or see is if you look at the total expense column, you'll notice that the expenses are rather large for the first 10 years of the policy. And typically that's where the insurance company makes its money. There are policy issue charges, premium charges that are only assessed on every dollar of premium that go into it. So those obviously cease after the 5th year. Then for the next 5 years, you've got the cost of the early cash value rider in this case, because it's an index universal life. And then you've also got the policy issue charge that runs through year 10. So we have higher fees all the way through year 16 ultimately, because that's when the early cash value rider drops off. If you were to pay a premium for more than just 5 years, that early cash value rider would be spread out over just 10 years, not 16. But when you short pay it like 5 years, they spread it out for 16 years for some reason. Don't know why. But what I want you to take a look at now, and this is pretty darn cool, I think, is look at year 17 of the policy. The total expense or charge on the policy is only $823 on top of basically $899,000 of cash value. If you get out a calculator and you do the math, you'll find that that number is very small, like under 0.25% of your cash value. And you can see that it stays very low for the rest of your life. You can't see that here, but it does. So basically, some minimum percentage of the cash value just simply needs to be spent on risk each year. And it basically just, there's always a little bit of a gap between the death benefit and the cash value. But the amount being spent on that gap is always less than 0.25% of the cash value. So what does that mean? It means if the policy earned a 5% interest credit that year, basically once they take the fees out, you would net about, somewhere around 4.75%, probably more than that. When I'm saying 25.25% of a percent, I'm being very generous, conservative. It's actually considerably less than that. So those are things that are covered in other videos, but this is a short video anyway, so I just wanted to reiterate some of the key features of a maximum overfunded policy and how much you can borrow against the policy. All right, so now I just want to take a look at some just important need-to-know things regarding life insurance or maximum overfunded life insurance. So when you're taking a policy loan, just remember that the cash value, the insurance company uses your cash value as collateral. So you always need to have extra money, a little bit left over to cover the fees and charges of the policy. There's always the insurance company dipping their hand in too. The next thing is you'll pay interest on the loan, but the cash value will continue to grow so long as you have a policy with a non-direct recognition loan. And it's also interesting to note that right now policy loan interest rates are actually lower than bank loans. That's not always the case. A few years ago when interest rates were really low in the economy, you could get a better interest rate from a third-party bank than you could from the insurance company. But now that things have gone crazy on the outside, and this is being recorded in July of 2024, it's much more difficult to get a low rate in the real world as opposed to from the insurance company. So just realize that this structure allows you to access funds while keeping your policy intact. You can put your money to work in two places at one time. And then just some final cautions and considerations that you should be aware of. And a lot of this is just a repeat just to drive the point home. The policy charges are deducted in monthly increments. So what you see on the illustration, that 15% that's lost to the policy fees and charges, that's not taken out all at one time. It's taken out in monthly increments, and over the course of the year, those monthly increments will add up to the amount that you see, the 15% roughly of the premium that's lost. Point here is that the cash value is higher after the premium is paid, and then each month, if you go online, you'll see it, gradually go down until the end of the year when you put in your next premium. And then it'll go back up and start going down again. Point here that I want to stress is don't borrow against that extra that you see. Just know that the fees are going to tally up to about 15% of the premium. So don't tap into that. All right, and then next is loan limits. If you borrow to the ultimate maximum, you jeopardize your policy if you default on that loan. It's one thing if you default on a commercial loan. They're if you miss a payment, they're going to come at you right away for that money. But with a life insurance loan, if you don't pay them the interest that's due on the loan, then they will loan you the money to pay themselves the interest. And the thing is if you've borrowed right up to that absolute limit and you don't have enough free unsecured cash value to make that extra loan to you to pay themselves the interest, that will cause a policy lapse. You'll need to get that money into the policy or the entire policy could lapse. Which brings us to our next bullet point, which is the tax implications of that. So if you have greater cash value than you have premium into the policy, and this might be the case after about the 4th to 5th policy year, the cash value will exceed the amount of premium that you've got into it. Well, if you borrow that extra and you default, then you basically get a 1099-C for the amount of the loan that's being wiped out. So you received that money and you have a capital gain because you have more cash value. Your investment is worth more than you have into it. So those are things that you really don't want to have happen. Point here is really just be conservative. The double play works. You don't have to take it to the ultimate maximum and stress the policy. All right, wrapping up, it's just important to know that it's possible to borrow about 80 to 85% relative to the premium immediately after the policy is issued. And as I spent a lot of time on here, just be aware of the caveats when you take a policy loan and the need to pay the interest on that loan and can keep it properly accounted for. So that's all I've got for the main presentation. If you're hungry for more information and you're not ready to talk to a life insurance agent yet, be sure to look for my double play group on Facebook. That's a community of people that are my clients, prospective clients, people that just found the group and are interested in it because they're investing in real estate using life insurance. But you can ask questions of people that are actually doing this. And then also just, make sure you subscribe to my channel so that you can see all the other titles. Again, just look for something that answers the question that you have about how this works. Look for titles. And then my website, innovative-retirement-strategies.com. I have a ton of information there in form of blogs and all my recorded webinars, and everything is available on the website. So again, everything that you need to know to answer any question you have is there. And if you think that I haven't answered a question, be sure to post the question in the comments down below. I keep on top of that relatively closely every day and usually respond very quickly to questions that are out there. And that way there, if you post it publicly, then other people can benefit from the information. And oftentimes, if it's something unique and I haven't covered it, I'll make another video for it. So with that, I will see you in the next video.